Okay, let's unpack this. Today, we're strapping in for, well, what feels like the ultimate masterclass in financial sanity. We are diving deep into the foundation of value investing. Benjamin Graham's classic, The Intelligent Investor. We're really zeroing in on those timeless principles, the ones submitted just before the 1972 revision. Principles designed to protect you from, frankly, your own worst instincts and the sheer madness of the market sometimes. Warren Buffett called this the best book ever written on investing.
Yeah, quite an endorsement.
Right. And not because it gives you some secret formula, but because it stresses that success doesn't need a stratospheric IQ. What it needs is a sound and solid mental framework, and crucially, the discipline to stop your emotions messing it all up.
Exactly. And that framework, it starts by drawing a really hard line, a line Wall Street constantly tries to blur.
Which is?
The line between investing and speculation. If you go back to Graham's original 1934 definition from security analysis, it's just uncompromising.
Leg it on us.
An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Simple as that.
And everything else.
Operations not meeting these requirements are speculative. Full stop.
That definition feels like it's built to last. But let's get some context. What was happening around 72 that made this rigid guidance feel so, well, necessary?
Oh, it was crucial. This guidance was really hammered home right after the big market downturn of 69-70.
Right.
That crash you see, it completely shattered the illusion from the late 60s. This dangerous idea that you could buy leading stocks at basically any price and you'd be fine, profit guaranteed.
Sounds familiar even today sometimes.
Doesn't it just? The market proved quite painfully that investors had to be ready for long, significant slides. If you weren't anchored in value, in safety, you were just completely exposed, vulnerable to that volatility.
Okay, so we commit. We're investors, not speculators. Graham then gives us two clear paths, right?
That's right. You've got the defensive investor, that's the passive approach, focused on safety, minimizing mistakes.
And the other?
The entrepreneurial investor, the active one, the one seeking market-beating returns.
But he warns against trying to mix them, trying to be somewhere in the middle.
Yeah.
Why was he so strict about that? Couldn't you just dabble a bit?
Because in his view, that middle path almost guarantees you'll be disappointed. If you dabble, you bring in just enough speculation to risk your principal. But you don't have nearly enough skill or focus to actually get those superior returns. You lose the benefits of both.
It makes sense. So whichever path you pick, there's one core idea separating investing from just, well, gambling.
Absolutely. It's the cornerstone. The margin of safety. That's your quantifiable protection.
Yeah.
Your buffer against mistakes, bad luck, the unexpected. It's what makes it investing.
And he makes it quantifiable. That's key, isn't it? He doesn't just say, be safe. He shows you how to measure it.
Precisely.
Like with something supposedly rock solid, like railroad bonds back then. What was his rule, the number?
The rule was strict. Pre-tax earnings had to cover the fixed interest costs at least 5 times over. 5x coverage.
5 times. Wow.
That's the margin of safety for that bond. It means even if earnings drop significantly, dramatically even, the principal is safe, the interest gets paid. That's safety in fixed income defined.
Okay. And how does that translate to common stocks? How do you find that margin there?
For stocks, the margin comes when you buy the security at a price significantly below its calculated intrinsic value, its real worth.
So like finding a dollar bill selling for 50 cents.
Sort of, yeah. Maybe you aim to buy at, say, 2/3 of what you calculate its true value to be. That protects you if your calculation is a bit off or if things don't pan out exactly as expected.
Got it. Now for that other path, the active entrepreneurial investor, the one chasing better than average returns.
Yeah.
Graham sounds almost intimidating about what that takes.
He is very clear. It demands an extraordinary commitment, time, skill, diligence. It's practically a full-time job, and you need a certain temperament.
And there's a huge warning attached.
Yeah.
If you try the active path but don't bring that extraordinary commitment, what happens?
The cost is usually pretty severe. If you attempt it and fail, which most who try probably do, you don't just get average returns. You typically do much worse than the defensive investor.
Why is that?
High trading costs, paying too much for those hot tips or trends, getting your timing wrong. It all adds up.
Yeah.
To consistently beat the market, Graham says, you need policies that are both inherently sound and promising.
Okay.
And not popular on Wall Street. You have to be willing to stand apart from the crowd, a true contrarian.
Which, let's be honest, very few people have the time, skill, or maybe even the stomach for.
Exactly.
So let's pivot back to the path for most people. The disciplined defensive investor. What's the simple core rule for setting up their portfolio?
Okay, the defensive portfolio is all about stability and managing your own psychology. You divide your funds between two main buckets: high-quality bonds and a diversified basket of leading common stocks.
Simple enough. Is there a specific split he recommends?
Yes, the specific enduring rule is this. Keep your stock allocations somewhere between a minimum of 25% and a maximum of 75% of the total portfolio.
So some flexibility there.
Right. But the standard balanced suggestion, a 50-50 split between stocks and bonds, and you adjust based on market levels, maybe moving towards more bonds when stocks feel expensive and vice versa.
I find that range, that 25 to 75%, really comforting, actually, because it acknowledges the psychological battle, doesn't it? Graham knew we're terrible at timing the market,
Oh, absolutely.
trying to guess the peaks and troughs. He basically said it's impossible, and trying is the fastest way to turn yourself from an investor into a speculator.
Precisely. And to fight that urge, that emotional timing mistake, he championed a mechanical tool, dollar cost averaging.
Yes, explain that simply.
You just invest a fixed amount of money at regular intervals, say monthly or quarterly, regardless of what the market price is doing. Buy more shares when prices are low, fewer when they're high.
And does it work?
There was a definitive study back then by Lucille Tomlinson. It looked at 23 different 10-year periods, starting between 1929 and 1952. Applying dollar cost averaging to the main DJIA stocks, it resulted in a profit every single time.
Every single time, even starting near the 29 crash.
Yep. Despite all the temporary dips and crashes along the way, it proved consistency really can beat trying to be a market genius.
Okay, consistency is key. But there's always that temptation, isn't there? The lure of the next big thing. Today, we hear a lot about growth stocks. If a company's expected to double earnings in 10 years, that sounds amazing. Why was Graham cautious?
Well, growth stocks are attractive on the surface. Doubling earnings in 10 years, that's a solid 7.1% compound return. But they pose this critical paradox.
Which is?
They are always priced high relative to their current earnings. Always. The market anticipates that growth. So the investor is forced to pay a big premium today for performance that's expected, but still uncertain in the future.
You're paying for hope.
Essentially, yes. You're speculating that the high growth rate will continue and that the market will continue to value it highly. There's often little or no margin of safety if things don't pan out perfectly.
And that uncertainty, that focus on price versus value, leads us to probably his most famous analogy: viewing the stock market as your partner.
Ah, Mr. Market. Yes, one of the most vital psychological tools any investor can have. Think of owning stocks like having a business partner, Mr. Market.
Yeah.
He shows up every single day, and he offers to either buy your share of the business or sell you his share. The price he quotes, though, it depends entirely on his mood.
He sounds a bit unstable.
Exactly. Some days he's wildly optimistic, euphoric even, and offers you a ridiculously high price for your share. Other days he's panicked, manic depressive, terrified about the future, and he's desperate to sell you his share for peanuts.
It's a brilliant metaphor for market swings.
It really is. Because if you, the intelligent investor, view your stocks simply as part ownership in a solid business you understand, then Mr. Market's daily mood swings, his crazy quotes, become irrelevant noise.
Or even.
Or even better, they become opportunities. When he's in one of his depressive fits, offering to sell cheap, you buy. When he's overly enthusiastic and offering a silly high price, maybe you sell. You use his irrationality to your advantage, like buying a house from someone forced to sell in a panic at half its real value.
That's the theory. Powerful stuff. But let's look at what happens when people or the whole market completely ignore that margin of safety and just go fully manic. We need those cautionary tales. Let's start big. Penn Central.
Right, the collapse of Penn Central Railroad in 1970. Huge company. It was a massive shock. Its stock had been flying high, up at $86.50 in 1968. Looked like a blue chip.
But the numbers told a different story.
A very different story. Remember that 5x interest coverage rule we talked about for railroad bonds?
Yes, the safety measure.
Penn Central's coverage was just 1.98x, way, way below Graham's minimum safety standard. A huge red flag waving right there in the financials.
And the market just ignored it.
Completely ignored the fundamental weakness. But reality eventually bites. The stock collapsed, down to $5.50. It was a stark lesson. Even supposedly safe companies, even their debt, needs careful analysis, no substitutes for diligence.
Okay, that was a debt story fundamentally.
Right.
What about just pure speculative craziness in stocks? The dot-com boom wasn't the first bubble, right?
Now, not by a long shot. For that kind of mania, look at AAA Enterprises. This was a 1969 IPO. The magic word then, franchising.
The buzzword effect.
Exactly. Investors went into a frenzy over anything using that word. The stock was priced at $13 and quickly doubled to $28.
Okay, but what did that price mean in terms of value?
It meant the market valued the company at a staggering 115 times its highest current earnings. Just an astronomical figure based purely on the buzzword and hope. No connection to intrinsic value.
In the ending.
Predictable, unfortunately. 2 years later, AAA Enterprises filed for bankruptcy. A perfect example of how destructive, pure, unanchored enthusiasm can be.
Wow. And sometimes it wasn't just hype, but actual financial engineering designed to obscure the real picture, like National General.
Yeah, National General is a good case study in complexity hiding risk. They used instruments like warrants quite heavily.
Remind us what warrants are.
They're essentially options. They give the holder the right to buy the company's stock later at a set price. Now, if you factored in the potential value of all these outstanding warrants, National General's true market valuation, the effective price people were paying for the underlying business, was almost double its quoted stock price.
So the complexity masked the fact that it was incredibly expensive.
Precisely. It hid the lack of substance, the dangerously high price, and no surprise it ultimately led to huge losses. The stock tanked from $37 down to $9 by 1970. Complexity often signals danger.
That complexity point is a perfect lead-in to the opposite approach, the enduring success of those who just stuck to Graham's simple value-focused principles. Buffett dedicated a whole appendix to them, didn't he? The Graham and Doddsville followers.
He did, and it's such a powerful piece of evidence. He used it specifically to challenge the dominant academic theory of the time, the efficient market hypothesis, the EMH.
Where the theory that says markets are perfectly efficient, all information is already in the price, so nobody can consistently outperform the random walk idea.
Exactly. Buffett cheekily called it the orangutan hypothesis, implying that if you had enough monkeys throwing darts at stock pages by sheer luck, some would appear to be geniuses. He argued the EMH suggested outperformance was just random luck.
But the success of these Graham followers, these super investors, wasn't luck, was. There was a common link.
Absolutely not luck. The common thread binding these super successful managers, people like Walter Loss, Tom Knapp, was their shared intellectual foundation, their methodology. They were all looking for discrepancies.
Discrepancies
between a business's intrinsic value, what it's demonstrably worth based on assets, earnings, etc., and the price the market was currently putting on its shares. They were finding those bargains Mr. Market offered in his low moods. Buffett had identified them years earlier based purely on that shared philosophy.
And what's really interesting is what they didn't pay attention to. No fancy algorithms, no market timing.
Right. They ignored all the stuff that academics and traders often obsessed over. Things like market momentum, trading volume, even technical measures like beta.
Remind us what beta is again.
Beta is basically the academic measure of how volatile a stock is compared to the overall market. High beta means it swings more wildly, low beta, less so.
And the value guys?
They ignore it. They stick to the quantitative, the verifiable, present earnings, financial strength, hard assets on the balance sheet. They aren't trying to predict future trends or guess market sentiment.
And Walter Schloss, one of those super investors, had a quote that just perfectly boils it all down, didn't he?
He did. His philosophy couldn't be simpler or more powerful. If a stock is worth $1 and I can buy it for 40 cents, good things will happen.
That's it. That's the margin of safety in a nutshell.
Pure distillation. Buy value at a discount and be patient.
And this whole approach, it leads to that really crucial Graham and Dodd insight about risk. It flips the usual script, right?
Completely flips it. Conventionally, we're taught higher potential reward means you have to take higher risk, more potential upside, more potential downside.
Makes intuitive sense.
But in value investing, it's the opposite. The higher the potential reward, which means the lower the price you pay relative to the proven value, the lower your actual risk becomes.
How so?
Because buying something clearly worth $1 for just 40 cents, well, that's inherently a low-risk move. Your purchase price is your protection. The discount is your margin of safety. Big potential reward, lower actual risk.
So bringing this all together, what does this mean for someone listening right now? The big takeaway feels, well, psychological as much as financial.
I think it absolutely is. Graham's whole philosophy offers you independence. Independence from the market's moods, from the crowd, from your own worst emotional impulses.
Yeah, that daily noise, Mr. Market shouting prices, it doesn't have to dictate your actions or your peace of mind if you've done the work.
Exactly. If you've done your homework, bought with that margin of safety, the daily or even monthly gyrations won't make or break you as a serious investor. The goal is that disciplined consistency, that independence of thought.
And it leads to that final kind of reassuring piece of advice from Graham.
Yeah, that achieving satisfactory investment results is actually easier than most people think. Stick to the simple, disciplined, defensive path. Use dollar cost averaging. Diversify. You'll likely do fine over the long run. But achieving superior results, consistently beating the market, that's much, much harder than it looks. It demands that extraordinary skill and dedication of the entrepreneurial investor we talked about. Most should probably aim for satisfactory and safe.
So in this world where Mr. Market is constantly yelling, acting like that manic depressive partner, what's one simple test, maybe a metric, that you, the listener, could adopt right now? Something to anchor your decisions in that quantifiable value, not just hype.
That's a great closing thought. Well, maybe you could adopt a version of Walter Schloss's approach. Look for businesses where the current assets alone, just the cash, inventory, receivables, things easily converted to cash, exceed the entire market price you're paying for the stock.
So you're essentially getting the long-term assets and future earnings potential for free.
Pretty much. That's about as pure a margin of safety as you can find. Think about powerful, simple metrics like that. How can you anchor your next investment decision in verifiable value, not just a story or a feeling? That's the challenge.